Hi, friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And we're so excited to be back with you guys. And we've had the pleasure of now having 2 interview episodes in a row. We've been typically interrupted in our regularly scheduled programming by market moving events. Unfortunately, this time we were actually interrupted by me. I got sick. And PSA to women out there, by the way, if you are ever in pain, do not be like, oh, it's nothing, whatever. I had to get rushed into emergency surgery on Saturday. I'm totally fine now. Everything's going to be fine. But do not ignore your pain and definitely talk to your friends about it, because Kristen diagnosed me over the phone. And I was like, there's no way. She's like, I think it's your ovaries.
I said, or a kidney stone, but yeah.
And I was like, to every hammer, everything's a nail because you're pregnant. Yeah, but so you were 100% right. So anyways, just never, if you're in pain, seek help.
I'm guilty of the same thing, but because I was talking to you and you were like, it feels like I'm being stabbed. And I was like, Jen, go to the ER. That's not normal, you know? So it's a lot easier when you have that distance.
Yeah.
And you can basically hear what your friend is saying. You're like, Jesus Christ, go. Like, what is wrong with you? You know?
Right.
But I think when you're just in your own life and you've got kids, you've got a job, you're just kind of going through the motions and you're like, well, I can't miss this XYZ thing. Totally. My child has baseball and then I have to take him to this thing. You don't want to be interrupted. So I actually totally get that. But it was funny. You made a comment we were put up on. You were like, my brain is working slower. I was like, Jen, you're on lots of pain meds. You're on drugs.
I am so much slower. It's visible, just everything. My movements are slower. My brain is working slower. It's been an interesting week, but thank you to all of you who reached out, to those of you who sent flowers and food. Trust me, you have been keeping us afloat here in the Starbucks household, because my husband is in charge of the grocery shopping right now and it's not pretty. But okay, so here's what we're going to talk about today. So first of all, our guest is Scott Bach, and he is the chairman of Greenhill, which was recently acquired by Mizuho. But Greenhill is one of the elite boutique investment banks. So this is evergreen content for those of you who are thinking about starting your career in the investment banking or financial services industry as a whole. We get this question constantly. Well, what's the best firm to start at? Mm-hmm. And there's 2 broad categorizations of firms that we typically bucket things into, which is—
or hear people wanting to go to. Yeah.
The bulge bracket investment banks and the elite boutiques. And we actually put this question to Scott, and I think it'll be great for you to hear his answer to it of what's actually the hard and fast definition of each? So it's great to get his perspective. We talk about so much. One of the things that we touch on that Scott gets into in his book, which just got released at the beginning of May. Yeah. Is actually his experience being chairman of the board of trustees at the University of Pennsylvania, which is very timely, not only given everything that's going on with endowments and the current administration. We're going to talk about the big, beautiful tax bill in a second here that just passed the House by 1 vote. But within that tax bill is now an increase on taxes for investment income for these big endowments, going from 1.4% to 21% for the big endowment. So that's a huge change that made it through the House in that bill. Obviously, the colleges like University of Pennsylvania and a lot of the other Ivy Leagues have been in the news a ton lately. And we didn't really discuss the topic of foreign funding, but foreign funding has been a massive theme throughout both kind of how it's potentially impacting the culture on college campuses and also how it's impacting our political sphere, with now the Trump administration having officially accepted a gift of
a $400 million plane,
a new
plane from Qatar.
Yeah. So I do want to have an episode one day about the mechanics of foreign funding. We touched on it only in the slightest with Scott and didn't get into it in a lot of detail, but we do learn some interesting things about how these boards work at these universities and how boards work at companies, something Scott has deep experience with on both fronts.
Well, and I want to add, Scott, by the way, he was also not only is he currently the chairman, but he was the CEO for 16 years. Mm-hmm. So he was there for the company going public and then ultimately then being sold to Mizuho. So it's actually just a really interesting story, because I remember when I saw that they were being sold to Mizuho and I was like, that's an interesting choice. And so anyway, the whole conversation was so fascinating, but let's talk a little bit about what's going on in the markets. So Jen, I'd love if you want to just start by explaining what the heck is going on with the 20-year auction yesterday and like some of the nuances of the 20-year to begin with.
Yeah, I think it's so interesting. So when I was on the trading floor, here's kind of the pace of flow of information. You have whispers in IB chats between kind of the movers and shakers of the world, the big deployers of capitals, the market makers, the thought leaders. And that's how information gets disseminated most quickly. By the time it makes it to a flashing red headline on Bloomberg or an article, it is old news. By the time it makes it onto CNBC, it is, as far as I'm concerned, like dead stale yesterday's news. That's how quickly the pace of information moves in the markets. Now, things have changed a little bit since I was on the trading floor because now we have added in the variables of Twitter, Instagram, TikTok, where news is also breaking about the markets occasionally, and Truth Social, which didn't exist and still doesn't exist as far as my phone is concerned. But Bloomberg actually had to structure a special thing where they would print Trump news headlines because he, wasn't allowed on conventional social media apps. So that being said, one of the things that is so interesting that I've developed the perspective of being out of the markets professionally is that we're learning in real time just how much we overlearn from the last news cycle and how we over-index to that information, at least from my point of view. So in April, when we had what I viewed as a legitimate potential crisis in the bond markets, no one was talking about it for what it was. There were all these theories based on what happened the last time we saw a crisis in the bond market. Yeah. It must be the basis trade. It must be XYZ. It must be the administration trying to convince the Fed to quantitative ease. No, we had a legitimate sell America trade happen in response to the tariff announcements and a lack of confidence in the US. And so we teetered very much on the brink with extremely low participation in our auctions and with very concerning price action in the bond market. So here we are now, effectively a month and change later, and we are following on the heels of a refunding cycle in tens and bonds that went very well. And I was having to fend off accusations that the Fed was secretively quantitative easing when in fact they are simply slowing the pace of their quantitative tightening as per. Yeah, go ahead.
And if you want to hear the explanation, Jen talked about that 2 episodes ago. And so Jen gets into like why, even though you saw some treasury purchases in the SOMA portfolio for the Fed, it was not actually because they're quantitative easing. And so just a quick recap for people who might not be like listening to every single episode. Big picture, right? If you think about just like the way that the Fed can control monetary policy, the sort of 2 most classic ways, and then there are other things as well, but like they can either, they set the short end rate, the overnight Fed funding rate, which is basically literally the overnight rate that banks borrow at from each other. And then there is, in theory, there's like the nuclear bomb version that now is just like an everyday, like la-di-da-di-da, but they can go out in the market and they can actively buy bonds that are longer dated. So that obviously, if you have more buyers in the market, it put pressure on those bonds. And so the yields in theory can go down. So when people saw that, oh my God, the Fed is buying bonds and they're buying longer dated bonds, that means they're quantitative easing. It actually doesn't. And so Jen explains that like, hey, some of the things that they had in their portfolio, like were rolling off and they don't want to shrink the size of their balance sheet in a huge way. So what they basically need to do is they need to replace some of that stuff, but they're replacing it at a lower rate. So it still means that the size of their balance sheet is shrinking. It's just shrinking in a lower amount. So they are not quantitative easing. Correct. That's the TLDR. Right. So yeah, so you are. You did so well. Thank you. So yeah, so I'm shut up.
But yeah, so what was it? Literally a week or 10 days ago, I was spending on accusations that the auctions were going so well because the Fed was secretly intervening. And now here we are. And we had a 20-year auction that tailed by, call it 1.25 basis points. And long end treasuries have sold off. So yields are going higher. And they're going higher. They're back around where they were in April, when we kind of hit the peak of the tariff panic, we've got long bonds, so 30-year bonds up above 5%. That's kind of a nice round number mentally for a lot of people. And so I was seeing all the talking heads jumping on social media, talking about, oh my gosh, the 20-year auction is moving everything, and it's giving everyone all this panic about all of a sudden what's happening with the Treasury market. Maybe, but let's talk about what else is going on. So on Friday, Moody's downgraded the US. So we have 3 primary credit rating agencies, S&P, Moody's, and Fitch. Moody's was like the last holdout that hadn't downgraded the US. The other rating agencies downgraded the US years ago.
Years ago, I think it was 2011.
You said that was the first one, yeah. And you were like, I thought they'd already done it.
I know. I thought it was already done. I was like, they've already been downgraded. Like, no, there was one holdout, and it was Moody's. And so they finally were just like, okay, let's just go ahead and do it.
And so this happened on Friday, and like the markets didn't even really care that much. Like, it just really didn't matter. And then all of a sudden, it's like everybody woke up, realizes we had a bond auction we had to digest, realized that we've been downgraded. And now this tax bill is finally in a critical position where it was being voted on in the House. And so in that milieu, with long end rates backing up 10, 15 basis points, everyone was panicking, saying, this is, oh my God, failed Treasury auctions. This is a, total lack of confidence in the US. I just disagree. I think that it's very legitimate for the markets to be questioning what it's going to take for the US to implement some fiscal discipline. I think that that's a perfectly reasonable position to take and say, okay, you now have some hard numbers around what a tax bill probably looks like. We now have the accurate information. Do we need to reprice yields in the long end higher to reflect greater spending over a long period of time? Most likely. But the market's doing so in what feels like a fairly orderly fashion. Not to mention, looking to the 20-year auction as the canary in the coal mine, it ain't it, guys. For the basically entirety of my and Kristen, your lives, we didn't even have 20-year bonds. We only had aged 30-year bonds that had rolled down the curve. I remember when you were explaining to me, like, oh, this is the process
DCF.
for calculating the WACC for the DCF. You're going to go take an aged 30-year bond. And I was like, why don't you just use a 20-year bond? You're like, they exist. But here's the thing. It's like shoe sizes, right? If you're a shoemaker, you're going to produce a lot of size 7s and a lot of size 9s and a lot of size 10s or 11s, right? Kristen, you have slightly larger feet.
Yeah, well, because I'm on the taller side. I'm like 5'9", and my feet are size 10.5. And they never made size 10.5 shoes. And even now they often don't. It's like basically goes in half sizes. And then at size 10, it jumps up to 11. Anyway, the 10.5 is not liquid.
Exactly. So it would be like if Nike was like, you know what we're going to do? We are going to make more size 10 and 1/8 shoe, right? And then be surprised when all the size 10 and 1/8 shoes don't fly off the shelves. There's not a ton of natural demand for the 20-year point on the curve. There's natural demand for the 30-year point and for the 10-year point. But the 20-year point on the curve has always been, for lack of a better term, kind of the redheaded stepchild of the long end. So structurally, it almost always has traded cheap to 10s and bonds, meaning both 10s and 30s typically have slightly lower yields, relatively speaking, than the 20-year point. The 20-year point needs to offer you a higher rate of return in order to entice you to come in to buy it. So to have the market need to back up and cheapen in order to take down a big 20-year refunding is a normal thing that happens in the course of doing business. For a 20-year auction to tail by then another 1.25 basis points, listen, it's not, oh my gosh, this auction was so great, but it's also not an unmitigated disaster. It's just like, well, okay, the 10.25 size shoes didn't fly off the shelves. So now what? Surprise, surprise. So I guarantee you, everyone who's belly aching about the 20-year bond auction has never talked about the 20-year auction before. Right? This is probably the first time that they have been so concerned about the belly of the long end, is my guess. So I would just caution you from reading too much into this particular data point. especially because these exact same voices were the ones wringing their hands about the strength of the refunding earlier in the year. To me, nothing has fundamentally changed, except for now we do have some concrete details of this tax bill.
Which passed like 2 hours ago. So that now it needs to go to the Senate, which is now going to be a whole other process. So we at least know what it looks like in the House. This doesn't mean that this is the final bill. This is not the final bill. This is just what's passed in the House, goes to the Senate. And then, by the way, you were asking me, you were like, has the Senate parliamentarian done their thing? So we had a really great conversation, if you missed it last week, with Representative Seth Magaziner, who's a congressman from Rhode Island, who was basically kind of explaining the process of the tax bill, what's in the tax bill, and all that kind of fun stuff. Because I was like, I'm so confused. How can you increase the deficit when, like, I thought it had to be deficit neutral to get the simple majority to pass? And he's like, oh, well, here's this little loophole. We don't know if it's going to actually be blessed by the Senate parliamentarian. So got to see if that happens. But anyway, he also was like, they probably would just fire the Senate parliamentarian if they don't bless it. So it probably is not going to be a huge stumbling block.
We'll see. Yeah. So, I mean, we do have new information about the overall scope of what the likely picture could look like. So we have some new hard data, and I think it's very reasonable for investors to say, you know what, this data points to more spending over the long term, less fiscal discipline. I therefore need higher compensation from long end investments to make up for that, right? Like this is not a revolutionary thing. It's not like the bottom's falling out. It's not like foreign buyers didn't show up for the auction. It's not like we had a failed auction. We had a small tail on an auction that like nobody likes anyways. So I would caution you from reading too much into this. Okay, so before we get to Scott's episode, we have a special gift for you guys. So we are over 300,000 followers on Instagram, which is absolutely mind-blowing to us. So thank you guys so much for showing up and supporting us. And we're glad that you're enjoying this content. As a thank you, we are going to host a free live virtual masterclass. And it's not just for people who are investment bankers, although of course it's perfect for that audience, but for really anyone who is either about to start your summer internship, about to start your full-time job, or you just want to kind of level up in Microsoft Excel and feel like you can navigate through it with confidence and use it as a tool. So we are offering a free 1-hour live masterclass. It's next Thursday, May 29th at noon Eastern Standard Time. And there will be a 48-hour replay. You need to register also in order to receive access to the replay. But Kristen's going to give you all the Excel tips and tricks that you need to feel comfortable in the platform. You can do it on a PC or a Mac. Both are welcome. Obviously, we know Kristen's preferences for Microsoft Excel on a PC.
I mean, you'll if you have both, I would do a PC. I use the analogy of like most corporations, if you're preparing for a summer internship, they tend to use PCs. So it's kind of like if you're going to learn a language and you have French or Spanish, but you're going to go live in Spain, learn Spanish, right? It's just, it's just going to benefit you more than learning French, which is similar, but then like there's still more work you got to do. So I would use the PC. We just did our actual 2-day formal financial modeling in Excel talent accelerator earlier this week. And it was so much fun. So we were like, all right, we need to do.
I learned so much, guys. I got to build my own first financial model.
Which was wild. She's literally there 2 days post-op, has mass, wounds, poor thing. And it's just she's like, Kristen, I missed this one thing. Can you send me your model so I can look at what you
Everyone
said?
else in the class was like, we're good, no questions. I was like, Kristen, can you send me your model? I think I missed a few steps. It's broken.
It was amazing. And then last quick announcement. This is very exciting. So Industry Season 2, Episode 7. Jen and I have it on our calendar. We are going to record the next episode next Tuesday.
I'm so excited.
It will be released in the next week. For those of you, it is,
are
to
you
Jen's
trolling
point.
us, guys? Seriously, we thought 5 people listened to that show. The amount of messages has only picked up in urgency, being like, okay, cool story. Where's Industry?
So
When's it coming back?
Yeah.
I feel like you guys are punking us, but either way, we love doing it. So we're going to get back to it. Yeah. We'll have our first Industry episode. We've got a bunch of cool episodes coming up too. We have an interview with someone who works at one of the GSEs. So you guys are going to get to learn all about that. We have some amazing stuff on crypto. I mean, so much in the vault that is just begging to come out. So now that I think the markets are cooling down a little bit, so we can get back to some big sexy stuff with people way smarter than we are. But this is a fabulous conversation with Scott, and I can't wait to air this episode.
Awesome. All right, let's bring him on.
So one of the most common questions we get asked is, I'm considering working at an investment bank. Which one should I work for? And specifically, should I be going to a bulge bracket or an elite boutique firm? What are the pros and cons? What are the opportunity sets? So we thought, who better to talk to than Scott Bach, chairman of Greenhill, one if not the most elite of the elite boutiques, which was recently acquired by one of the largest banks in the world based in Japan, Mizuho. And Scott, you are the author of the newly released book, Surviving Wall Street, A Tale of Triumph, Tragedy, and Timing. And by the way, the 3 T's makes me very happy because my senior thesis at Princeton, I had 3 R's. And so I get it.
You like that alliteration.
I do. And Scott, you actually started your career in law. You worked for Wachtell Lipton, which is one of the most prestigious big law firms in the world. And then you actually broke into investment banking at our alma mater, Morgan Stanley, back when investment banking was kind of in its infancy or toddler years, before it really was the established career route that it ultimately became. And then you finally ended up at the helm of Greenhill. And Greenhill, for those of you who don't know, again, is a boutique investment bank specializing in mergers and acquisitions. We'd love to hear your story because hearing me tell it sucks. Like, you are going to do a way better job than I. So talk to us a little bit about how you fell in love with banking in the first place and about the birth of the elite boutique.
Sure. The starting point for my book and the notion that I even wanted to write one at all was that investment banking was such a tiny field way back in the day when I got out of school. So obviously it's grown to an enormous part of our whole economy and our society. But back then it was very small. I graduated from Wharton. I literally did not know what an investment banker was. I graduated in May of 1981. On that day, the federal funds rate was 20%. The Dow Jones Industrial Average was just under 1,000, which it had first passed in the 1960s. This was now the 1980s, right?
Yeah.
So it was an incredible period of stagnation. I knew only one person in Wharton who got a job on Wall Street, one person in the entire class I was aware of. So it was very, very small. I didn't know what they did. And if you had the kind of background I did, middle class, middle of America, you knew about doctor and lawyers, sort of the ways to get ahead in life. And so I chose law, and also in a crummy job market. I've joked that law school is like the last refuge for people who don't know what they want to do.
Yep.
And so I went to law thinking that's what I would do, got a job at Wachtell Lipton as a summer associate and then permanently. Wachtell was also tiny then. My class got it to 66 lawyers was the size of the firm then. Now, it was already a super elite firm. It was known as probably the best one in the M&A world, which was kind of just beginning then. But so I got that job at Wachtell, and through that, I quickly learned what investment bankers do because we worked with them all the time. Mm-hmm. And, as I kind of expected would happen a couple of years into it, I started hearing from headhunters, hey, do you want to move from Wachtell Lipton over to the investment banking side? And I tell the story in the book. It's just kind of a funny one that my wife and I are driving to the Jersey Shore one Saturday in the summer while I'm thinking about what I want to do for a career. And the New York Times Magazine cover story is entitled Lawyers Becoming Investment Bankers.
Oh, so, no kidding.
So I thought, wow, I'm really part of a trend here potentially. And actually worried about it a bit, thinking, oh my God, now every lawyer is going to think this is what they need to do. And will I be lucky enough to find a job? But I ended up talking a lot to Drexel Burnham, which ended up going down in flames, but it was really on top of the world at that moment, and Morgan Stanley. Mm-hmm. And friends said, hey, Morgan Stanley, that's the bluest of blue chip you can't miss if you go there. So I joined Morgan Stanley about 2.5 years into my law career. I had an amazing experience there. I was there for 10 years in total. Half of that was in London, so I got to work all over Europe. When you talk about how much the banking industry has grown, when I went to London for Morgan Stanley in 1990, its offices were like in the district where the doctor's offices were. It wasn't in the city of London. Canary Wharf didn't exist then. Yeah. Tiny, tiny place. So I had this amazing sort of bulge bracket experience, right, both in the US and in Europe for Morgan Stanley, but eventually decided to transition to what was then a very, very small startup called Greenhill. And that really was kind of what kicked off what became known as the elite boutiques, was when firms like Greenhill formed.
And so what would you characterize as the key differences between what we call a bulge bracket firm and an elite boutique? This is one of those things where I feel like every now and then we'll see on social media a list of like, these are the best bulge bracket firms and these are the best of the elite boutiques. And then you'll see someone publish the same list and it'll be totally mixed up and jumbled. And by the way, there'll be cross population between the two. And you're like, how do you know? Right. I feel like it's like pornography. Like I know it when I see it, like it's a bulge bracket. So I'd love it if you could give us some framework within which we can discuss the differences between these two different types of investment bank.
Sure. And, and to understand that, because it's really is a nuanced sort of answer to that question, I need to also tell you a little bit of history again, which is when I started out in investment banking, there were just dozens and dozens of firms, but they were all quite small and specialized. I mean, you didn't work globally. You didn't work in both investment banking, trading, consumer banking. That hadn't happened yet. I mean, Glass-Steagall, the federal law was still keeping those things separate. Very few firms had much of an international presence. I mentioned how little Morgan Stanley's presence was back even in the early 90s in London, let alone across the rest of the world. So what I saw happen in the early part of my career was this massive consolidation. I mean, there were this whole group of so-called British merchant banks, S.G. Warburg, Kleinwort Benson, Baring Brothers, Robert Fleming, et cetera. All of them got merged into mostly American, but in some cases Swiss or German banks. Likewise, in the U.S., we had these specialists in technology. Back in the day, it wasn't, Goldman Sachs and Morgan Stanley that led most technology IPOs. It was Robertson Stevens, Alex Brown, Montgomery Securities. All those firms also got bought up. So you had this massive consolidation. So by the time I was sort of 10 years into my career, it felt like the whole investment banking business was owned by really 9 firms. Mm-hmm. There were 6 in America, there were 3 in Europe. And what Greenhill was formed really is kind of almost like a retro thing. We were going to be a backlash against that. Everything had consolidated into 9 firms. Clients were starting to figure out that, hey, if you're selling me all these products, maybe you're not always completely on my side. And so that's when I broke away from Morgan Stanley. I wanted to go to a place where what I did was really the core business. Mm-hmm. At that time, Jennifer, you and I were talking a little bit beforehand about some of the colorful commentary and the swings back and forth in the industry. But at that time, trading was really ascendant. Mm-hmm. And one of my mentors at Morgan Stanley had a great quip about how if you're in investment banking, you're the hot dog stand in front of the casino. Because you can have the best hot dogs, you can be the best hot dog salesman in the world, but if the boys in the casino, i.e. the traders, are having a bad day, the firm's having a bad day. Right. And so it was kind of in that spirit that I thought I want to move out to a place that what I did was M&A was really the core. And then what happened really after that and where we are today, so to get a long way of answering your question, the industry has kind of refragmented into so many different sectors now. So there are plenty of elite boutiques, but there's also a layer of other ones that are more specialized. Maybe they work in just one industry. Maybe they work in just one country. Mm-hmm. Likewise, there certainly are more international firms that have gotten involved in the U.S. investment banking business, including the one that acquired Greenhill, but also, the Royal Banks of Canada, the Nomura's, places like that. So today, I think the question, it's not as simple as just saying, which flavor do I want? It's more, which firm do I want? And where am I going to get the mentoring and the broad experience that I need to have a long, successful career? Because whatever that career looks like when I'm 22 years old and graduating, it is not going to look that way when you're 32 or 42. So you need to be in a position where you can kind of grow from there.
I'm actually curious, how did you guys start? Because it's so interesting. I remember when I was doing a lot of the corporate training, Greenhill had a reputation for getting the best and brightest, like more so than even like your Goldmans or Morgan Stanleys. And so I see a little bit of parallels now with sort of what's going on at elite universities where so many people, they choose to go to say like a Harvard or a Wharton for the brand. And I think that same idea when you're choosing your bank, if you're right out of college, you're choosing almost like the brand. So I'm curious, how did you guys, as almost like an emerging up and comer, like as you said, like Greenhill, it was a small bank when you joined initially. How did you guys build the reputation and how were you able to attract the top talent and grow that brand the way that you were?
Well, part of that was Bob Greenhill himself. He was the founder of the firm. He was president, sort of number 2 person at Morgan Stanley when he left there. He founded what we thought at least, claimed at least, was the first M&A department on Wall Street. Certainly he founded Morgan Stanley's M&A department. I mean, literally, he and 3 other people. If you read the book done years ago called House of Morgan by Ron Chernow, who later wrote the book that inspired the musical Hamilton, Chernow tells that story. It was like a 4-person, hey, I bet we could charge clients money for merger and acquisition advice. Bob, why don't you set up a department and we'll start doing that? Mm-hmm. And as I note in the book, it really at that time was considered an innovation to charge clients for M&A advice. Because up until then, companies, firms on Wall Street were so focused on underwriting. That's where they made all their money historically. They were so focused on underwriting. They thought M&A is almost like a gift with purchase kind of thing. Like if you give us all the underwriting business, we'll do this. So Bob had a big personality, and he founded that first M&A department. He flew his own airplanes, flew the Citation 10, fastest non-military aircraft in the world. And so he had some real charisma about him. And so that helped us hire people early on. But then on top of that, in terms of a cultural sense, we offered a small firm feel. I mean, we still aspire to do that today, to offer a small firm feel where people feel like they're really getting mentoring and coaching and guidance. And also at the end of the day, a brand on their resume that lets them do a lot of different things. And that's why even early on, we were able to get really, really good young people out of the top schools in the US. And I think that continues to be the case today.
I want to ask that question in a little bit of a spicier way, if I may. One of the things that we've had a lot of conversations about and has become part of, if you will, like the culture in speaking about the differences between different firms is we've talked before about the Goldman discount. So many people join some of these bigger bulge bracket firms saying, I'm willing to accept whatever it may be. Maybe it's a lower salary. Maybe it's slightly inferior working conditions, longer hours, less specialization, less of a close relationship with a mentor for this name on my resume. From a monetary standpoint, from a compensation standpoint, or from other elements of what goes into making a job a great job for someone, is there truth to that? Is there truth to the fact that working at the elite boutiques, okay, hey, listen, maybe you don't have Wharton on your resume, right? You may have a name that's not necessarily a household name, bringing it back to the college comparison, but maybe you have a lifelong career here versus this is just a stepping stone onto something else. Is there truth to that from, your top-down view? What do you think about that?
Look, I think young people, as they choose their careers, ought to try to think past what brand am I getting for my resume and where am I going to really have an opportunity to learn and grow and be mentored and coached. And I won't attach any particular names to this story, but I've known people, and at this age now, I've known people whose children have gone to the biggest brands in Wall Street. And I always remember one woman who was in my class at Wharton going way, way back, and she'd pop by New York because she'd lived elsewhere in the country. When she'd come by, we'd always meet, and she had the son. She was an amazing kid, all the best grades. You know the story. Everybody's got kids like that. And she was so proud that he got a job at one of the mega banks. I mean, just could not have been more proud. It was like a mother's lifetime of effort. And now we got this kid, this job. And so she swings by like the next year when she's coming through New York and, oh, how's your son doing at XYZ? He's not there anymore. He hated it. And so if you go to a place just for the brand or just because maybe it pays the most money, even if it gives you an extra $5,000 a year in base salary or something, I think it can be a mistake. You have to really think about where am I going to feel good on Monday morning about getting up and going to work? Where am I going to like the peer group that I'm with? Where am I going to like the people that I'm working for? And they're going to treat me like a human being. And so you can be part of a bigger bank, certainly, but you want to be in some niche. And it could be, maybe it's an industry group, maybe it's a product group within a bigger place, or maybe it's a smaller institution you go to, some place where it doesn't feel like a factory, where it feels like you're a human being. I made the comment in the book that, Wachtell Lipton in my eyes when I was at that very small law firm was like the Navy SEALs. Navy SEALs of the legal world. You want to feel like you're part of the Navy SEALs or part of the New York Yankees or part of the Green Berets. You don't want to feel like you're part of a General Motors factory. And so whether you get that through a mega firm where you're in a small cohesive group or go to a smaller firm, I think that's a wise thing for young people to do.
And one other question, just because this is obviously a huge trend amongst young people these days, partially because private equity firms recruit so heavily, and especially like they love M&A bankers. It's a known thing. Like if you want to go to private equity, it's like you go to M&A. What was your view on these private equity firms coming and poaching talent? And now they're poaching so early. It's like literally while these new hire analysts are in training. I'm just kind of curious, is there resentment, or do you like not really care because you're like, well, we're just going to go and recruit out of business school, so it's fine. I'm curious, and like, is there a way that you guys are trying to keep people at Greenhill? Like, you hire the best and brightest. Like, how do you keep people and not have them want to jump ship before they've even started, by the way?
Look, I'd say one of the negative phenomenons in sort of, elite circles, whether you're talking about college, business school, law school, or the firms all those people go to, is that everything is so accelerated. It's like you can't enjoy the new job you got for 15 minutes because you're interviewing for the one you're going to take in 2 years. I've got a daughter of a good friend who I like to play tennis with, is a first-year law student at Harvard Law School, and she's talking about right now she's interviewing for her next summer, not the summer just about to start, for her next summer. I mean, gosh, it'd be great if you could just live in the moment for a period, but the industry is competitive enough that you have to just live by what the rules are. The rules are that there are going to be people who view you more as a rite of passage. They'll be there for 2 years. Maybe some will stay longer, and we always strive for that, and we succeed in a number of cases. But you have to accept, most of these people are trying to build a resume, right? They went to the right college. They do 2 years at an investment bank. They do well. They do 2 years at a private equity fund or maybe hedge fund. And then after that, they figure out what they want to do. It's almost the equivalent of like getting a master's degree back in in an earlier era. And you just kind of have to accept that. And everybody parts friends. A firm like ours, and I'm sure the others as well, these amazing alumni networks of people who are, close to each other. They help each other throughout life. They may give advice. They may invest in your next fund. They may give you introduce a client to you. So you can't keep people. It's not the world my father grew up in where he worked at the same place 37 years and then retired. That's not today's reality.
Yeah, it's kind of like when you start dating someone and people are like, well, when are you getting engaged? And then you get engaged, and like, have you set the date? And then you get pregnant and they're like, well, have you thought about having another? Like, it's always the next thing and the next thing and the next thing. But I mean, your longevity within the firm, is truly tremendous. And you oversaw multiple periods of crisis. Your book is called Triumph, Tragedy, and Timing. So there were obviously multiple financial crises that you weathered, and also kind of tragedies of a more personal level. And I'd love it if you could talk through some of the common themes as we are now here. It's Friday, April 25th, in one of the wildest periods in the markets that I've experienced, having lived through '08. But you lived through also long-term capital management, 2001. You have such a bigger perspective. And I'm curious, what are the lessons you learned going through those crises, and how do you interpret them in the lens of what we're going through today?
Yeah, you could say the book is largely, that's the survival aspect, right? It's surviving crises. Number one, they come fairly frequently on Wall Street. I view that the life of our firm, there were 5 significant crises: the long-term capital hedge fund blow-up, the dot-com crash, the financial crisis, the COVID pandemic, and then lastly, the sort of combination of the Ukraine invasion with the COVID recovery that spiked inflation and interest rates and all that. So they come fairly frequently. So don't let yourself get lulled to sleep thinking it's just going to be like wonderful for the next 15 years of your career. That's probably lesson number one. I did think, and I wrote in the book, that there were some common characteristics they had. And it's a little bit of a funny cycle in a way, if you think of it this way. Number one, they come from a place nobody's expecting. The long-term capital hedge fund blow started with a Russian debt crisis. Mm-hmm. Now, Russia is not a place, as an M&A banker, I ever gave 10 minutes thought to, right? It's just not what was relevant to me. And I think likewise, people who worked in, U.S. equity capital markets or so many other areas wouldn't think that. Number two, even though it catches everybody completely off guard, within a very short time, everybody looks back and say, well, it was obvious that was going to happen. It's amazing how quickly you go from nobody expecting it to, well, everybody knew that. And, you think even of the pandemic. Bill Gates did a quite famous broadcast where he talked about the next pandemic, we're not ready, was the title of the thing. And nobody really listened. And 3 years later, we got walloped with this massive pandemic. And people like, well, we had several of these and we were due for a big one. And so that's kind of step number two. Step number three is you hear this talk of, well, this could be the end of the world as we know it. And even take the long-term capital hedge fund blow-up, which most of your listeners will be too young to know about, but it was a big, big thing in the very late 1990s, about a year after I started at Greenhill. And what kind of startled me when I was doing research for the book is like 6 months after that crisis was over. And I would say in retrospect, I think, well, gosh, that was nothing like the global financial crisis of '08, nothing even like COVID. That wasn't that big a deal in retrospect. Time magazine cover story was titled "The Committee to Save the World." And the picture and the 3 people on that cover were Alan Greenspan, former Fed chief, Bob Rubin, Secretary of Treasury, and Larry Summers, who's still pretty prominent and about town today. who was a senior economic advisor and later became president of Harvard and so on. So you think, wow, people, that's what they thought. They thought save the world was what that was about. So you do get this sort of doom mongering thing of like, boy, the world's going to come to an end.
Yeah.
And people felt the same with COVID, right? Are we ever going to snap back? Is New York ever going to be the same? Are we ever going to go back to offices? But then, despite all that gloom and doom, we human beings are a crafty, resilient group of people, and we figure out how to get through these things. And people's, after hunkering down a bit, they start spending again. The economy gets going again. Stock prices, which have been beaten to death, will eventually rise back up. And then the last phase of these crises that I point out seems to always be an attribute is people basically forget all the lessons. So we never learn anything.
100%, yeah.
So we go from didn't see it coming, oh my God, it was obvious. Then world's coming to an end, then world doesn't come to an end, and then you kind of just move on. You don't really think about that again. And so that's why the next crisis ends up coming from a completely different place. And, and every time, and it's probably just a flaw we have as human beings, it's like we're shocked every time. We're caught off guard every time.
Yeah.
But the reality is you have to be resilient, you have to be ready. The firms that, and the individuals for that matter, that are most ready in terms of a conservative positioning for themselves, a broad skill set that can maneuver to other opportunities and so on, they're the ones who do well. And frankly, I always thought in my career, in my life, that I viewed the downturns as the period to move ahead.
Yeah.
That if you picture yourself almost like on a ladder or something, you're a young person trying to battle your way up the organization, up the industry in some way. Take a couple of years ago, people who are doing SPACs, boy, those people are just coining it. I wish I was one of them. I wish I was a SPAC person. And then you have these periods where like the ladder shifts down and you just by staying where you are, you end up moving up relative to others. So that's another observation about these historic crises.
So following up on that, because you were talking about making sure that the firm is strong and can withstand the storm that's potentially coming. In general, the trading revenues are obviously huge recently and M&A activity is drying up. So I know you guys have been approached multiple times about potential sale. What made you decide to finally say, okay, we're going to go with Mizuho and we're going to go through with this transaction and sell?
Yes, good question. And there's a whole chapter in the book on that as well. I think, I think in Wall Street in particular, such a competitive place, such a dynamic place, ever changing, et cetera, you have to sort of go, figure out where the puck is going instead of where the puck has been. And just like if you think back to when Greenhill was started, it was when there was really almost no firm like Greenhill, but it was this huge consolidation, the 9 big mega players. They had all the business, they did all the different products and so on. And so we were kind of pivoting in a different direction. If you look how things played out over the next 25 years, I mean, it was an amazing, wonderful 25 years. But at the end of that, you look and think, okay, now there's a lot of firms that look a lot like us, and maybe we're better off continue to be Greenhill, but be Greenhill within a bigger institution that has these other products. Because you're absolutely right. In different periods and markets, there are different parts of the firm that do very, very well. And if you're in the trading business, you're going to do very well when there's crazy volatility. If you're in the M&A business, your clients are going to freeze up a little bit as to what they want to do. And so I felt after a long, long time of really enjoying our independence and really thriving in that format that it was a good time to think about being part of something bigger. And so made the decision at that point.
Can we back up a few steps and like 15 years to the decision to actually go public? Because that ties into a couple of other themes that I want to get your take on, specifically control of these institutions that are very precious to you. How much control are you willing to share? How do you have influence over them? So talk to us first about the decision to go public and what kind of happened as other firms saw your example.
Sure. So at the time we were a young firm, the firm started in 96, I joined 97, you get to sort of 2003 or so, we're 6 years into it, everything's going great. If you looked at the history of firms like that, it always ended with them selling to someone, and even fairly early in their life, they would sell and the firm would kind of disappear. And I, one summer, was doing some work actually for Charles Schwab, which was a client of ours, and we were helping them look at acquiring a bank across America. Now, in the end, as with so many M&A assignments one gets in life, the deal didn't happen. They ended up forming a bank on their own and built a wonderful business, and Schwab's obviously a very, very successful company. But I did some work for them. And as I was looking at banks for them to buy across America, I noticed, wow, these banks, they're less profitable than we are. They have maybe a regional name, but not a national, let alone a global brand name. They probably don't have the growth prospects we do because we're very young. They're very old. I just thought, I wonder if we could go public. It literally popped into my head on vacation in summer of 2003. I wonder if we could go public. No firm had ever come to us and said, hey, Greenhill, we'd like to take your firm public. I mean, it was just popped into my head. And so I talked to Bob Greenhill about it a day after Labor Day that year. And we kind of agreed, look, we'd had a few years in a row of 100 million of revenue, which for a very small firm was amazing. And we thought, if we do that one more time, we're going to call up in January. And so we waited. We did beat that figure. We showed growth again, et cetera. And so on the first business day of 2004, we called up Goldman Sachs and a few others and had them come. And the objective there was to both, it's a little bit of have your cake and eat it too. Like you get to realize the value you've built. You get to then later cash out and actually take the money home. But you're not giving up control and you're not changing the nature of your business and so on. So we had this IPO that was like wildly well received. I mean, we were like 100 people at the time. It was, I think we were 16 times oversubscribed. Wow. For the offering. We had a $500 million valuation at the end of the first day. And, again, that's for 100 people and no assets at all. Our phones and our desks, basically. And in the next 18 months, the stock quadrupled. So it was a $2 billion valuation for maybe by the 125 people. So it was a remarkable success. And that did set a precedent that others looked at and thought, hey, I wonder if we could do that. And one of the chapters in the book is entitled Greedy People Watching. And where that comes from is on the day we went public, there's a guy from an earlier era named John Goodfriend. He was a famous banker. You guys will remember him. There was one famous Business Week cover once that said King of Wall Street and had his picture on it. He was the head of Salomon Brothers back in the day. Big bond trading guy. And he was long retired by then, but I guess he was, doing one of these interviews with Bloomberg that day and said, hey, Greenhill went public today. Got any comment on that? And John Goodfriend says, I'm sure there are a lot of greedy people watching. Mm-hmm. And what he meant was exactly what played out, which is a lot of people thought, hey, not a lot of assets, not a lot of history, few smart people with some relationships got together and look at that. I wonder if we could do that. And so that became, and still is, a big niche in the industry now. There are many firms. Lazard was the first one to follow us a year later. Evercore was about a year after that. Many others followed. So it kind of set a new path for value realization if you build something. Now, the other thing you need to know about IPOs is that the process of going public is great fun. You find out you're
I think there's sarcasm. Is this sarcasm? Is that sarcasm?
Yeah.
No, I said going public, creating that, and then you suddenly realize that you created this thing. It's worth so much money. Your shares are worth a lot of money, et cetera. Being public,
there we go,
is not as fun as going public.
Yeah.
Because interestingly, the number of publicly traded companies in America in the life of Greenhill has fallen in half.
Yeah, I mean,
that's a pretty amazing stat.
This is something we've been talking about, right? It's just the total, basically, wholesale disappearance of the IPO market. And it's one of the structural issues that's impacting all of investment today. And it's not, I don't personally have the solution, but we're living in a totally different world than in 2004.
We definitely are. And you have a lot of public companies disappearing, mostly through private equity taking private or other just corporate mergers between two public companies. But you don't have much of a pipeline of new IPOs coming in. And so the number has shrunk dramatically. There's a lot of work being involved in being public. There's a lot of kind of always being on display, like every quarterly result, every appearance you have, anything you say to your employees, you might as well be saying to the whole world, but especially in today's world. Everything gets out. So I really enjoyed the process of going public. Sometimes people say, boy, that's tough. Are you glad you did that? I mean, yes, I'm glad I did that because it was a huge success. And those of us who were part of it benefited greatly from that. But there's a point at which you say, you know what, I think we've done that long enough. And it's maybe not so bad to be part of a bigger institution where not every single thing you do is quite so scrutinized.
I would have thought that even the process of going public would be quite difficult. Just even like trying to get a mortgage these days, like the amount of paperwork and like all the stuff that goes into it, it just feels like it would be so daunting. I did want to go back and talk a little bit more about just the global financial crisis, because Jen and I mean, she was sitting on the trading floor at Lehman. I was sitting at Morgan Stanley working in CDOs, and we were talking about just kind of like, SPACs. Like, I feel like they completely dried up for a while. But I'd love if you could talk a little bit about just like, you were there seeing some of the negotiations happening, seeing what was happening on the regulation side. Like, what do you think was one of the most important things that almost like shapes the industry to where it was then to what it is today? Like, what are some of the key takeaways from that?
I think people have said over the years that regulators are like generals fighting the last war. If you think about that war, if you want to think of the global financial crisis as kind of a war, I mean, it was a big war. And there were a lot of soldiers that died in that war. Bear Stearns, Lehman, Washington Mutual, others that got absorbed, Wachovia, that were big institutions back then. But it led to a lot of regulation in the industry. It led to like really amping up oversight, capital requirements, all those things. And the industry is still really suffering from those things to some degree today. I know in the banking world, they're hoping that there's going to be less regulation under the new administration. And maybe that pendulum will start to swing back. But the financial crisis, I mean, that one really was a scary one, right? That was the worst crisis in 80 years. I mean, you've got to go back to the Great Depression, right? I mean, my grandfather was a child then. It's not like I have any knowledge of that, but I do know that people who lived through that, including my grandfather when he was alive, I mean, they were scarred forever because that was just really, really scary. And I think likewise, the global financial crisis here, where it was a really dramatic time. I remember in that period, like every Sunday night, it's like the government had to pull another rabbit out of the hat. You had to be close to your phone or your computer on a Sunday night because there was going to be something announced, because they'd be in a panic about, when Tokyo opens up, is it going to be plummeting again?
Right.
What can we do?
Right.
Some new rules, some new facility, some new investment, some new way to prop up the economy a little bit. And so it was a harrowing time, but if you had any money and the courage to invest, like March of 2009 was the bottom of the stock market. So it's almost right there, right? It's a matter of a few months. And then things started to turn around. But there were a lot of scars left, not just on the firms that disappeared, but I think on all the other ones as well.
We spoke to Steve Eisman, who people may not know as a household name, but they probably recognize him as the character played by Steve Carell in The Big Short. And we were talking to him, and one of the things that he was saying that we need more of is diversification within the banking industry. That the lesson that was apparently learned by the regulators of the 2008 global financial crisis was that we, in fact, need more too big to fail banks, and we need to have them all merged together, and we need to have basically fewer independent institutions. We need them all under one big umbrella that rhymes with Schmapey Jorgen, right? So like, I am curious to get your take on that, having been at the helm of truly such a small independent institution for so long that is now part of a larger institution. What do you think? Do you think there's any merit to that assertion, or do you disagree?
Well, I think if you're a firm like Greenhill was, I mean, you're very small, but you take almost no risk. You don't have balance sheet risk. You're not trading. You don't have assets that boom and bust in value all the time. If you're at a place that does hold those kinds of assets, or do have even deposits, frankly, that can disappear, then I think scale obviously is very, very helpful. I mean, even to think well past the financial crisis to the most recent bank crisis when Silicon Valley Bank went out of business. I mean, they were pretty niche. I mean, people thought Silicon Valley Bank very successful. My gosh, they banked probably the richest part of the world, right? I mean, what could be more successful than banking these wildly successful American tech companies and their executives who have so much value in stock options and things like that? So, again, as often happens in financial markets, you look at that and think, boy, what could go wrong? I mean, what a wonderful business strategy Silicon Valley Bank had, and yet it went under. So I think you do have to think about diversification. I mean, at Greenhill, the way we thought about diversification, even within advisory, was very early on, we got into the restructuring advisory business.
Right.
So when M&A was booming, maybe there wasn't that much debt restructuring to do. When M&A was down, it's probably because the economy was bad. When the economy's bad, companies are in or near bankruptcy, and they got advice from us there. And so most of the elite boutiques followed us into that business. We did it all the way back in 2001 because we thought, even though there's not a lot of risk in advising, there may be more or less to do, but it's not like you're going to lose money advising, that it was good to have different types of advice and even different countries. I mean, there can be Another form of diversification is being in different places. I mean, we found, for example, that in a period when Europe was really struggling, in Australia, we were doing really well. I mean, Australia's economy is more linked to like natural resources, and China. Europe's was more linked to the banks and really took a beating in the financial crisis. So you want to diversify, whether it's by type of advice or if you're a bigger institution, type of customer. Obviously, Silicon Valley Bank had pretty much one type of customer, and try to build resilience in your firm is sort of the goal. But notwithstanding that, no matter how much building and planning you do, I mean, almost every crisis, there are other institutions that sort of topple over. And,
Yeah.
the goal is to not be at one of those when it happens.
Well, I'm curious, because you guys obviously didn't have the issues of the structured products and all that, but I remember sitting at Morgan Stanley and people kind of looked at Morgan Stanley and Goldman as the next Lehman. At the time, I remember the classic trade was to buy CDS on, say, the banks, so on Morgan Stanley debt, while shorting the stock, which is basically like buying insurance on your neighbor's house and driving the car through the door. And so was there ever concern that you guys were going to be a casualty in the financial crisis, or not really? Because
there really wasn't. I mean, we came into it so strong. And frankly, at that moment, I mean, it almost was the opposite, really. When the big banks got into trouble, and as you note, I mean, Lehman obviously completely disappeared, Bear disappeared. Morgan Stanley and Goldman both really came close. I mean, it's because they were in just like a matter of days, they were turned into banks. They got authorization to be banks. Yeah. Being a bank gives you access to the Federal Reserve borrowing window, and you sort of have as much liquidity as you need. Yeah. Citibank, they struggled for a long time after that as well. So you look at, when I referred earlier to sort of 9 big banks that controlled all of investment banking, very few of those 9 actually made it through that period without sort of a near brush with death. I mean, JP Morgan did, but hard to identify really any others that just sort of sailed through that. But the market assumed that because all those firms were teetering, if not already toppled, that we would sort of inherit the earth, that it would all come our way. And so we did a lot of hiring at that moment. We expanded to different countries across the US, different industry sectors. Really a weird story, but I talk in the book about how markets can be just so volatile that our stock hit an all-time high the week Lehman Brothers failed.
That's crazy.
Now, in a way, it makes no sense at all, because trust me, when I went home at night that week, I was worried about the future too. Just thinking, is there ever going to be another merger deal we could advise on? I mean, it seems like the world's really shaky right now, but the world looked at us and said, among financials, that looks like about the best house in a bad neighborhood kind of thing.
Yeah.
And so we hit an all-time high that very week, which there's a Warren Buffett quote I refer to a couple times in the book about how in the short run, the market is a voting machine, and in the long run, it's a weighing machine. In other words, the short run is kind of about popularity or emotion, things like that. Emotion was very much in our favor then. In the long term, it's a weighing machine. The market really determines what you're worth. But people were overconfident in us in the financial crisis, but there was never a risk we were going to go down. It was just a matter of, might we have a tough year or two? And in fact, we didn't even have that. We did very well for the first few years of that crisis.
Well, and so again, applying some of the lessons you learned then to now, with M&A activity having dried up so much with all the uncertainty we're experiencing in the markets, who do you think wins? How do you, as an advisor, approach your clients and say, okay, I have the clarity, I have the path, here's how you should position yourself, here's what we should be doing, never let a good crisis go to waste, these are the opportunities. How do you develop that insight? What skills do you call on to be able to give clients that clarity and help them act in a time when no one feels confident acting?
I think one of the greatest skills you can have as an investment banker is just unflappability. It's just keeping a cool head in a crisis, analyzing a situation, figuring out where the opportunity is, where are the risks, yes, but where also are the opportunities. And I think most companies, most of the clients of investment bankers out there, I mean, they have the same sort of predilection that most individual investors do. They kind of get excited about buying at the top, and they're kind of worried about buying at the bottom. And so your role as a banker is to try, when appropriate, to explain that, look, maybe the fact that there's not a lot of M&A, maybe the fact that prices are down, maybe the fact that the world seems a little scary, maybe that is fully discounted in valuations. And if you have the ability, if you have the balance sheet, the credibility to make a strategic acquisition at that point, I mean, it can be incredibly advantageous rather than waiting till everything looks great again. By then, prices are way up. Now, Now, clients obviously are always going to be wary with bankers, and this is the challenge you have as a banker, is you can't have the client just think you're just a cheerleader for deals. I mean, good times, bad times, you're always going to be in here telling me I should buy something. You don't want to be that kind of banker. So a few generations ago in Goldman Sachs, there was one of their leaders who talked about long-term greedy. You don't want to be short-term greedy and try to rush your clients into doing deals that just be so you can earn fees.
Right.
But if you have the kind of reputation where a client thinks, you know what, when this person comes to visit me and makes presentations and presents ideas, they really seem to be in my interest, not necessarily in the advisor's interest all the time. And sometimes they'll tell me now's not the time, or you shouldn't do that deal, or maybe one of your arch rivals is buying something you'd like to buy, but they're overpaying. Don't get into that bidding war. If you have that kind of reputation, then you can help that same client in the darker moments by saying, hey, now's the time. You got a real opportunity here when there's not a lot of competition and prices are down, so you should go ahead.
One thing I'd actually love to pivot a little bit, this has been obviously huge in the news, is what's going on with universities in light of what just happened with the administration sending a letter to Harvard, the rules about things changing with endowments. So you were on the board of trustees at UPenn. So I'd love to hear your perspective on what that was like, what challenges you see these universities facing, and do you see shifts in almost the perception of these elite universities over the next, say, 5, 10, 15, 20 years?
Look, I think it's the most complicated moment for those universities in my lifetime. Even back in the 1960s, when I was a child, there was unrest there, the Vietnam protests, civil rights protests, et cetera. But I think the universities as a whole felt pretty stable then. I think much less right now. And people get so influenced by little sound bites and little stories and things like that they put too much emphasis on. But if I think back, I was on the board of Penn for almost 20 years, and I was the chair for the last couple that I was on the board. And for most of that time, I would say universities like Penn were really in a golden age. It was like everybody who had a smart kid in America was trying to get their kid into one of those schools. Everybody who had a smart kid sitting in England or Germany or South Africa or India was trying to get their kids into those schools, not the homegrown schools. So you had all this growing numbers of applications. So you got better and better classes every year. You had alumni donations, more and more generous. We've been through a boom time. It's kind of the story of my book, really. The Dow Jones went up 40 times in the period of my career. So there's a lot of money out there, and a lot of money was given to universities. That meant financial aid got tons better. I mean, when I went to Penn, I was on financial aid for sure, but most of it was in the form of loans.
Yeah.
Later it became more like grants. So gosh, your family can't afford it. Fine, here's the money. And places like Penn and many others are able to do that. So you had that as a positive. You had amazing research breakthroughs on cancer treatments. And Penn, they came up with mRNA that led to the COVID vaccine. And so it was kind of a golden age. And even in a cultural sense, I mean, these campuses were happy places. How many times do you see some friend or cousin or niece or nephew or whatever who's 21 years old and they're at college and they'd say that they're not having fun? I mean, it's pretty darn rare, right?
Yeah.
I mean, people love their college years. And even at the board level, it was incredibly harmonious. I didn't see really a substantive argument or debate or even a moment really of emotions flaring at a board level in almost that whole 20 years. So what we have now is kind of a pretty almost existential sort of crisis, I think, that has arisen, and people are questioning what's really going on at these schools. And they have ideas like, these kids are all radical and the professors are making them that way and we need to clamp down and so on. But, the reality is that at universities today, more than ever, they're more careerist than ever.
Say more. What do you mean by that?
I mean, most college kids right now are probably watching your podcast or another one, trying to figure out how do I get a job on Wall Street, at Google, at a big consulting firm. They're very focused, not just on exploring,
not just learning
university.
For learning's sake,
right?
But
I mean, I
learning
think maybe
with
they should be as a stepping stone to get to a fabulous career opportunity. So people are very, very focused on that, and very few people on campuses get involved in protests. The ones who do can make a lot of noise, and they can sometimes say or do things that are inappropriate, but you're talking about a fraction of 1%. The other 99% are studying hard, applying for internships, and going to college basketball games on the weekend. So I think universities need to work hard to market what they do for America better than what they've done. I think they maybe a little bit took it for granted that people all assume that elite universities are great places and playing a great role. And look, they can be sources of frustration in the sense that people's kids don't get into the school they want to go to. So there can be some negatives that come out of that. But I think it's important. I think these universities collectively help the country understand all they do for them. And that's not just cancer breakthroughs, Alzheimer's, and so many other things that important research is being done. But even just the fact that America leads in innovation in almost every field you can think of, right?
Yeah.
I mean, if you literally made a list of the 50 most important companies that were formed in the last, 25 years, I mean, a huge percentage would be American. Whether you're talking about AI or electric vehicles or, your phone, your tablet, your software. I mean, that's almost all those cutting edge fields, biotech, pharmaceuticals. Those tend to be dominated by Americans. And if you say, well, who runs those companies? It tends to be people who went to, call it the top 50 or 75 schools in America. And who does the extraordinary research at those companies that creates those products? Well, it's the same people. And you could even say politically, like, where do those people come from? And whether Democrat or Republican, it's pretty much the same schools, right?
Yeah.
Donald Trump, Elon Musk, Scott Bessent, J.D. Vance. I mean, they went to Harvard, Yale, Penn, Princeton. So I think the universities have been a wonderful source of innovation and also a source of social mobility. I mean, the fact that someone like myself, as I note in the book, I mean, my dad didn't graduate from high school. My mother was 18 years old when I was born. Nobody in my family had gone to college. And, I ended up having a pretty decent career. And I think I can thank Penn for that. And there were plenty of people, even in my class, who did even better than I did. And they didn't come from any special place either. So if universities can do a better job marketing that we are great sources of innovation and wealth creation for the country, we are great sources of social mobility for kids that didn't have all the advantages, and our student body and our faculty is really very heavily focused on, just teaching these kids what they need to do to go off and have a successful career and a great life. I think they can get through this, but it won't be easy.
Scott, I have a couple questions. Well, first of all, in your book, there's a great line in the opening about how actually you share the same last name as a former president of Harvard. And you were like, just to be very clear, this is not like some nepotism story. But I do want to understand a little bit better, as someone who has no experience with this, what exactly is the role of the board of one of these universities? What can they control? What can't they control? Why did you join the board in the first place? And what does that look like from an insider's seat? Because you read the headlines now with so much turmoil on these campuses, with them being such a critical focal point for conversations on both sides of the political spectrum. And I simply don't know, as a layperson, what the board is or isn't responsible for and what they can control. So I'd love if you could kind of just educate me on that. Sorry. But I'm very quick to admit what I don't know.
I can absolutely do that. And let's start with first the broader board issue, even in the corporate world. There's a phrase I use a lot in the book because it's one I coined many, many years ago, that serving on boards is generally either boring or scary. And why do I say that? When things are going well, the CEO doesn't really need your advice, doesn't really want your advice. And so you're going to go to meetings, they're going to feel pretty mundane. You're going to go through the same, accounting reports, litigation reports, building projects, new products, and so on. They're not that exciting. But almost every company ends up going through a period that is downright scary. In my lifetime, even thinking a ways back, who were the companies that seemed the most bulletproof, the most impenetrable, the most respected? You'd say Enron was. I mean, they were often, Forbes called the most respected company in America. General Electric. I mean, Jack Welch was definitely the most respected businessman of the generation sort of before mine. How about Boeing? I mean, Boeing was the biggest industrial company in America, hugely respected, a couple of unfortunate airplane accidents later, and the place has been under a lot of pressure since then. How about Morgan Stanley? I mean, I thought even when I went there, you both worked there. I mean, Morgan Stanley, you can't get, in my view, much more prestigious than that. And yet in the financial crisis, I mean, John Max tells this story in his book, the plane almost crashed into the side of the mountain right there. So you do have these moments in almost every board. And what a lot of people would not guess, but I make the point in my book is that I think that's just as true in the nonprofit world as it is in the profit world. And most people say, well, why would that be? You're just there to, it's a good cause. Everybody's aligned. Everybody's excited about whatever the cause of your nonprofit is. And what possibly could be contentious or difficult or unpleasant about that whole experience. But my experience, and I wrote about it even apart from what happened at Penn, before what happened at Penn, examples where I've seen that play out that way, where the scary bit happened also at a nonprofit. What makes the scary bit even scarier in the context of a university is it has different kinds of governance, right? In a corporate world, it's very clear. Shareholders own the company. They elect the board chooses the CEO. The CEO is pretty much all powerful. Mm-hmm. And until that CEO gets fired, that CEO can kind of do pretty much what he or she wants to do. In the university world, there are no owners, right? It's a nonprofit institution. So there are no shareholders. The board kind of chooses itself in a way, right? The existing board retires some members, brings on some new ones.
Yeah, like how do you even get on the board at a university? Like other than, again, my assumption, and correct me if I'm wrong, is you give them a bunch of money and they're like, hey, don't you want to come be part of this? But I have no idea.
Well, there's some truth. There's a kernel of truth in what you're saying there, and maybe more than a kernel. Look, if you look at the boards of elite universities, by and large, those are very successful people. And I think it's a mistake if they go toward, let's just rank our alumni by how much money they have and let's invite the ones who have the most to come on our board. I think that's a mistake to carry it too far, but clearly success in our world is often measured in monetary terms, does drive a lot of people onto boards. But once you're on that board in the university, most people will very understandably think, oh, I'm here. This is wonderful. I love this place. I went here. My kids went here. I've got such warm feelings. It helped me have this amazing career. And so this is going to be fun. It's going to be a networking thing. I'm going to meet other smart people who went to my university. I'm going to be really in the know on the new interesting things happening on the university. No one joins a board like that, a nonprofit or especially a university, thinking, boy, I bet this is going to be really hard work and sometimes quite unpleasant. So nobody thinks that way.
Right.
And that's why when you get a scary moment in the corporate world, it's like people are half expecting it, right? In the sense that companies go through booms and busts. They have problems. I mean, you think about the auto industry many years ago, kind of restructuring. You think about the banking industry and all that went through in the financial crisis. You think about some of the challenges to the pharmaceutical industry at various points. I mean, you're kind of used to some degree of rough and tumble dealing with markets and economic volatility. In the university world, people just aren't expecting it. I mean, they just think we're all here to cheerlead for our school, to give money to our school, to be there for the ribbon cutting of the beautiful new buildings that we're opening, and to cheer on the fact that every year we got even more people applied to come to our school than we had. I mean, this is wonderful. It's just nothing but fun. But when you get a crisis like that, it's a big board. It tends to be people chosen in many cases because of the donations they've made. They're on for long terms. They're busy in other parts of their lives because they run businesses and things. And suddenly you have this crisis come, and then even then they don't have full control. You have to share it with faculty and other constituents. So it's set up in a way that it's not well suited to deal with a crisis. And right now we've had a meaningful crisis.
I'm curious, actually, how many people tend to be on the boards of these universities? And Jen and I were talking about this too. When it comes to companies, is it usually 13 or does it totally vary? I mean, this is like going to sound so ignorant, but what is the number? Like what is normal?
Look, in the corporate world, I mean, Greenhill was a very focused firm, not that complicated, and the employees, including myself, owned a lot of the firm. So we didn't feel like we needed a huge board. So we always had high single digits. If you're at a bigger company, a bigger public company, I mean, I would say between 12 and 20, a normal board. You wouldn't want to get much bigger than that. And I think that's probably a pretty good range. University world, again, because it's partly an honorary thing, partly a networking thing, partly what I'd call a cheerleading thing as opposed to like really hard work. Schools have very different philosophies, and there are schools like Harvard that have very small boards. They have other kind of subsidiary boards, but if you read about the Harvard Corporation, for example, and the people who've been in the news a lot just recently, I think that's maybe not even a dozen. There are places like Penn where we had, at the time the crisis really arose that I was involved in, I think there were 48 voting trustees, and there were probably 25 other emeritus, i.e. sort of retired trustees, but who still were around and interested and so on. And I remember because we did a little study of the different schools and so on, a place like Cornell was much bigger than that. Cornell had a huge board, much bigger even than Penn's 48. And I believe it also had a practice of letting emeritus members kind of come to all the meetings. So they had almost like a little auditorium full. A place like Penn's would have had a large meeting room. And then if you have one as small as like Harvard's, or I think Yale's is pretty small too, you can sort of sit around a big dining room table. So it's quite different. And there are pros and cons, obviously, to each one. If you want to give out that honorary title to more people because it makes them more excited to help your institution in various ways, you're going to have a bigger board. If you want to really just focus on governance and running a place, you might like a smaller one. But I think when a crisis hits, like certainly we're in the middle of right now, I think it's probably pretty tough whether you're sitting at Harvard with 12 of you or sitting at Penn with 50 of you or Cornell with 75 or whatever the number is. There's no easy way through that. It's not what people are expecting when they join the board of the school that they're an alum from.
I think that's a really critical point from my understanding, because when you read news headlines about like, oh, the board this, the board that, in my mind, I'm envisioning these people who day in, day out are thinking about every aspect of the operation of a university. I mean, I'm on a board, to be fair. And like, I haven't answered 3 emails that have been sitting in my inbox for 2 weeks about the thing that I'm a board member for. I feel terrible about it. I just haven't had time. But like, I mean, gun to my head, if you ask me what's going on with that organization that I care deeply about and want to give back to, I couldn't tell you the first thing. So I think that having that perspective, understanding that to some degree, you are approaching it from a standpoint of, again, this is an honorary thing. Like, we're all here to have a good time and like kind of boring. And like this meeting could have been an email. To then frame it, can you talk to us a little bit about the crisis of the past 2 years and what your experience was like? Because again, I think always hearing someone's perspective from the inside is so different than what you read in the headlines. And we're totally open-minded and want to get your take on it.
Sure. The last 2 chapters of my book are about that. And even people who are pretty close to it have read those and thought like, wow, that's a pretty gripping tale of what you went through. But it was just a very complicated crisis in that it involved notions of free speech, who can say what on campuses. It involved questions of anti-Semitism. You don't want free speech to breach over into being anti-Semitism. It involved things like the role of a university, like when something terrible happens in the world, should a university put out a statement? Should they have a view? I would say not all that long ago, universities tended not to. They lived in their so-called ivory towers and they focused on their business. Then you start having things happen like, a Supreme Court case making abortion more difficult. And you had universities that would speak out on that. Or the George Floyd murder that occurred in living color on our screens a few years ago. Universities spoke out on that. October 7, universities spoke out on that. And that's a little bit of a slippery slope when you start doing that, because you become a little bit more of a political place and you end up with interest groups on different sides trying to get you to say different things and speak out on different issues and so on. So many schools have pulled back on that now, but it was the cauldron of all these things: free speech, anti-Semitism, to some degree a backlash that has become quite meaningful in the whole country against DEI, that anything you can attach that label to, it's just a terrible thing. Why are we doing that? And so you end up with these debates with people, even within a board, like, what do people feel about that? Do they feel like we've had affirmative action, later called DEI, forever? Are we on board for that or not? And we've always had a very free speech, kind of open campus policy, but some people are really uncomfortable with some of the things being said now. Should we be cracking down on that or changing our rules for speeches on campus? You hear a lot of talk about, should we have so-called time, place, and manner restrictions? Like, sure, you can have a protest on our campus, but at these times, in these places, and in this way. And so you have a lot of suddenly very complex issues that have to get resolved. And it was a pretty intense period for that few months or so toward the end of my time serving there. And it really was, I think, in many ways, the beginning of what became the debate we had even in our presidential election about how do we feel about these issues. And I won't surprise you, I have opinions on all those things. I mean, I look back and think, are these schools really that woke? It seems to me like students are very, very career focused, and most faculty are teaching things like computer science and statistics and economics. So I don't think they're all that radical. And I remember back to my freshman floor in the dorm, every single person was white. I mean, that's pretty amazing, isn't it? I bet that wasn't the case for either of you because you're a bit younger than I am. But of my 25 people, every single one was white. Nobody even of Chinese or Indian descent, or let alone black or Latino. No international students. I mean, that's the way the world looked back when I started. I don't think that was a good thing. By the time my children went to college, you had incredible diversity. And I think, sometimes I think about it that the university is in many ways more like a city than it is like a corporation. A corporation, you can tell people what to do, and if they don't do it, you can fire them. In a city, you're trying to oversee a vast population, and universities are certainly in the tens of thousands if you think about the whole community of faculty and administrators and students and graduate students and all that. In a city, you're overseeing an incredibly diverse population. People have different interests. They have different religious views. They have different political views. They'll clash in some ways. But yet, I think most people would say to live in a really diverse city is incredibly stimulating. And it's very enjoyable. And I think it also creates a lot of innovation. I mean, there's a reason that places like New York and Boston in certain fields, and San Francisco in certain fields, and London have become such amazingly productive, interesting places, not only to live, but to create and to build. And so I think I'm an unabashed proponent for diversity. I will certainly acknowledge that, maybe it got a little too bureaucratic, the whole process of DEI. Maybe there's a little too much focus on like words and sensitivity about phrases you might use or labels you might use. And I think the goal, of course, is to make everything as much a meritocracy as you can. But I think there's room within that to also try to have the kind of diversity that can create amazing stimulation for your kids and friends when they go to those colleges, and when they come out, they're ready to take on the world because they've worked with all kinds of different people.
It's so hard. And Jen and I have talked about this. I mean, obviously we are two women and went and worked in Wall Street where there is significantly fewer women. I always would observe that at the analyst level, you would have, it wouldn't be 50-50. It would probably be like 40% women. At the associate level, it would thin out. I mean, there would be classes I would teach that were like 20 people and there would be no women, But the hard part is that then there are so many policies that get put in place that have the right intention, but there's the backlash. It's like where then people, I mean, obviously Jen and I are on social media, so we just get like all the trolls, but like we'll have people who are like, you only got your job because of DEI. And so the perception that it's easier becomes a problem, but even though you're trying to encourage people to, it's so complicated. I don't envy people having to make these decisions because it's like, it's not black and white. And anyone who tries to pretend that like this is an easy answer to a lot of these things, that's not the case.
I'm glad you brought up the issue of women. I mean, it's kind of an the forgotten, underrepresented group because we have gone a long way. We've come a long, long way. But I remember back when, I knew some of the women who were like the very first managing directors of Morgan Stanley. I worked for some of them. I mean, there's one who many years later served on the board of Greenhill. So I older than I am, but she's been around a long time. And she was one of the first MDs at Morgan Stanley who was a woman, and she got sent to Tokyo. And she always would joke about how in Tokyo she was such a rarity. They called her the lady businessman. And it's ridiculous that people troll you for you got your job for that reason. Like, it's not like back in that era that we ran a pure meritocracy to see who were the best 100 people to be in our analyst class. And what a coincidence. It's 100 white men. What a surprise that is. But yet, back then it was 100 white men. Right. And then later, women started trickling in, and then racial and other minorities started trickling in. And now you look at Wall Street. I mean, it's like they're running so many of the important businesses. So is the process by which you say, okay, we have almost no women in our associate class, or our VP class, or maybe in our MD class. Is the process going to be perfect by which you say, okay, how are we going to change? I mean, probably not. And there's probably going to be some bureaucracy about it. There's going to be some mistakes. There's going to be somebody you're going to be sorry you hired or whatever. But by the way, there are plenty of men you hire that you're sorry you hire. I mean, you're not perfect in your selection, but I think what's really unfair, whether you're a woman or whether you're a kind of racial minority, is people think, well, when we hire a guy and he fails, it's because, well, we make some mistakes once in a while. And if we hire a woman or a racial minority and they fail, well, it's because of DEI. Mm-hmm. Yeah. No, it's not. It's because you're doing what you should be doing, which is trying to increase the funnel of opportunity, which is great for mankind, but it's also great for your firm.
Yeah, we get all the equal opportunity trolling. We get, you only got your job because of DEI. And then we got, oh, you only got your job because you're not a woman of color or you're cisgender. So we get it from all ends. Like, we can't do anything right.
Yeah.
But, I think it does raise the bigger question, which is, I think, something that we're grappling with on a countrywide level, which is to what extent should corporations and universities be the arbiters of culture, right? And be the arbiters of opportunity? And how do they set that framework? How much of a hand does the bureaucracy have in that? And I think even just getting the perspective from you that like, it kind of wasn't in the job description of being a board member, if you will, that like you'd be the one adjudicating this, that you'd be adjudicating matters of free speech. That seems almost above the pay grade, but like then whose job is it at that point? And who should set the tone? And how much should political protest and social justice be part of the college experience? You talking about all these career-driven kids on campus, that's what we see in our role, right? But that's not what you see in the pages of the news. In the pages of the news, you see something totally different. And we're so fortunate that we get to have these one-on-one conversations with, truly some of the most brilliant and inspiring young people today. And we'll get off the phone with one of these kids and we're like, if this is the future, we are okay. Like the kids are all right. But then you see some of the hate and the anger and the vitriol coming off of these same campuses. And I'm like, okay, I can't see, or I can't really tell who I'm looking at, but is that the young woman that I just had a call with? Is that the young man that I just had a call with? Because these two things seem completely at odds. Right. And so it's so confusing to us as outsiders to try to understand, like, what is the actual sentiment on these campuses? Where does it come from? Who's leading that? Is it coming from the kids? Is it coming from the board? Is it coming from the faculty, right? And who's making those decisions? I'm a Princeton alum. I care so deeply about that university. I care deeply about my high school. Like I feel so deeply tied to these institutions and I want to see them thrive and I want to see them succeed. And I want to see other people enjoy them the same way that I did, right? I didn't have a college experience that was fraught with protest.
Me neither.
But we were in school at a time of great relative peace.
I also went to Brown. I also was an engineer and I was like a nerd, but it was not my experience at all. I'm with you. I was like in the library. Well, actually I didn't study in the library, but I was studying. I was going out to bars. Like I wasn't involved in like this social justice stuff. But again, it was 2005 and just
there was
nothing
one
was really
protest
happening
at Princeton during the entirety of my time there. And it took place off campus. And it was like the local soccer moms pulling up in their giant SUVs with signs that said no blood for oil. And then they got back in their giant SUVs and drove away. Like that was it. So it was a very, very different time. And so for me to understand it through the lens, I remember when I started at Princeton, they had the different residential colleges at the time. And one of them was less fortunate architecturally and has since been demolished. But I remember it was this bizarre, circuitous maze of dorm rooms. And I was like, what acid trip was someone on when they designed this dorm room? And it was specifically designed so that were there to be protests, you like couldn't get a crowd to get up enough momentum to like trample people marching through a hallway. Like that was literally part of the architectural design.
You are lucky because, by the way, like the anti-riot dorms, Brown still has them. It's called Grad Center, and they are miserable. So you're lucky that yours was demolished.
Riot-proof dorms. So, like, we are aware that colleges have this history. We just didn't participate in it ourselves.
Yeah.
So, with all that being said, back to you, Scott.
Okay, with all that being said, here's the overarching comment I would make, which is so much of what you hear on social media or even in quality newspapers and television about universities is really a caricature. Take the issue, we didn't need to spend a lot of time on it, but this issue of foreign funding. I mean, one thing you know about top universities, when they get a big gift, what do? They announce it to the world.
Yeah.
They want everyone to know because then other alumni think, oh, big gift, important cause, maybe I'll give to that as well. I mean, they don't hide these things. So I remember there was an issue of pen at one point where some people in Congress thought we had all this money from China. And very, very little money had come from China. And ironically, we found that most of it that came from China was because Wharton has a connection over there, went to Wharton. And I thought, boy, isn't that kind of funny, really? We're worried about what? The communists learning to be capitalists by patronizing Wharton? I mean, wouldn't we like the communists to become capitalists? So that's a total red herring. And on the issue of protests, I mean, I've seen lots of protests on campus over the years. You do go through periods that are quieter, but I mean, I can remember way back in my youth, really, the South African apartheid
Mm-hmm.
protests. You know, much more recently, the anti-fossil fuel protests. I mean, we had some trustees meetings at Penn that got disrupted to the point where we had to shut it down because there were some fossil fuel protesters who were there. And then more recently, obviously, the Gaza protests. What all of those things have in common, I think literally since the Vietnam War protests, is that you're talking about less than 1% of the student body. It's a very small group. I never saw 500. I don't know. Penn would have probably 20,000 undergrad and graduate students combined, and it would have obviously a huge community of faculty members, administrators, and even community members who can wander around the campus. I never saw a fossil fuels protest with 250 people, let alone with 1,000. I mean, not even close. It was more like 50, 25, things like that. Likewise, with even the Gaza protests are quite small. So where is the other 99%, call it the silent supermajority because it's almost everybody? In the library. They want to get into med school. They want to get into law school. They want a job at the elite boutique and investment banking. They want to get a job with a consulting firm. And if they're more of a, community minded, maybe they want to get a job at Teach for America or something like that. But they're not. These places are not radicalized. They really aren't. And most professors who are on these campuses are teaching things like economics, statistics, finance, real estate, engineering. And yeah, people are taking history, but there's an interesting cover story actually to Penn's alumni magazine. I think it's the most recent issue. It's called the Pennsylvania Gazette, named after the one that Ben Franklin had. You get it? Okay.
You got to hear my husband's important alum.
And the cover story was on the changing nature of the courses you take. Put aside what you're majoring in. Just like the number of people taking a history course has plummeted over the years.
I'm sure.
And it's because it's filled up with stuff like computer science, and it's filled up with people wanting to do engineering, or people who are trying to get a dual degree because they love English literature, but they also want to get a Wall Street job, so they're majoring in like statistics or finance or something. That's the real nature of campuses. Is it a period of exploration for kids? Yeah, and it should be. They hopefully do explore different ideas, and maybe sometimes they even get involved in a protest they don't really want to be a part of ultimately, but kids are going to grope their way through, and they're going to get excited by different causes and things like that. And I think a huge proportion of it is pretty darn harmless and even positive. Now, when it goes too far, obviously it needs to be investigated, dealt with, et cetera. And we certainly did that at Penn. But I think, unfortunately, what in particular I think social media does, we saw this in spades during the crisis at Penn when I was there, is it'll take the little Instagram video of some quick moment on campus, on this huge, many acre campus. Right. There'll be one corner where something's happening and it looks like it's a huge crowd, but what it really is like 47 people. And most people are walking by on the way to the library or on the way to the college basketball game or whatever. But it can seem like the campus is in flames. It can seem like, boy, these students are all they're social activists. And the reality is that students really are more like Wall Street warriors than social activist warriors at this point.
Well, I think it's interesting, your observation that people are divesting out of the humanities intellectually in terms of their time on campus. I also wonder to what extent there is a little bit of cause and effect there in terms of, I think people actually do seek development of that side of their brain and their intellect in one way or another. And if because of the competitive job market, they're being pushed into the comp sci majors, even if you're going to study English, you got to really focus on these other things. I do think that there is this longing in so many people to still try to understand the world in that very human way. And I think nature abhors a vacuum. And so if that isn't the focus, if that isn't part of the curriculum for everyone in the same way that it used to be, I mean, when I got to Princeton, even though I wanted to be an astrophysics major, I took something called the humanities sequence, where you read the entire Western canon, starting with like the Iliad and the Odyssey, going all the way to the Brothers Karamazov. And that ultimately led me to become an English literature major. But like, it's because I wanted that knowledge and I wanted that understanding, and I wanted to be a part of those conversations. And if you're not part of those conversations as part of your academic course load, you're going to seek those conversations elsewhere. Where so many kids are instead turning, right, is instead of getting it through their college course load, they're getting it on TikTok, or they're getting it.
Yes, that's so true.
They're scratching that itch to learn about the world.
That's true.
And they're not learning about it in the framework of, here's all the facts of history laid out. And by the way, you have to spend years studying that. And now let's talk about the nuance. Instead, they're getting, here's a hot take and here's clickbait. Exactly. And that's all. And that is, they are so going to over index to the most radical thing. Right.
So true.
And they don't have the framework.
Exactly.
Yeah.
Right.
Like
And
the framework is the key. The history, the framework, the where does this fit in? What does it compare to? Now, look, I had more than my share of success, including on Wall Street, which is a place people may think you need to like go to some particular training ground for. But if anybody's trying to think about what they want to study, what they want to read, what they want to think about, I am such a huge proponent for the liberal arts because think about when I graduated, and it's going to be the same for people graduating today. When I graduated, even from Wharton, didn't know what an investment banker was. And the phrases private equity and hedge fund did not even exist. Okay, so you think about where were the big opportunities. Take even like biotech for people who are more sort of science oriented. That wasn't a thing back then, right? So if you think about neuroscience, I mean, at Penn, they had this major called biological basis of behavior, which later got changed to the very catchy, more neuroscience. But, all those are new fields. So if you're going to have a 40-year career, don't assume the world's going to stay static for that whole 40 years. And so what you're really best off doing, I think, learn how to read critically, learn how to think, learn how to write, learn how to argue, learn how to debate, learn how to make a presentation, learn how to do math, and you'll be able to figure out whatever you need for whatever twists and turns the market takes and the economy takes over time.
Oh, well, Scott, I couldn't have said it better myself.
Last question, I promise. I know we've kept you over, but given what is coming in the world of AI and how that's going to change industries, the types of jobs we do, would you still pursue a banking role? And what do you think young kids should be pursuing these days?
I mean, my own story, I wouldn't really change anything. Some people want to do very, very narrowly one thing, whole life. That's what I want to do. I mean, I always viewed myself as kind of an all-rounder. I'm not, maybe not that good at any one thing. I don't know. But I did law, I did banking, I did restructuring as well as M&A. I worked in Europe as well as the US. I worked in different industries. I got very involved in the nonprofit world, not just at Penn, but in a number of places. And I always thought I want to be involved in lots of things. I want to try lots. I even wrote a book. How about that? I never thought I'd be an author, but I think the broader skill set you can develop, the more you're ready to pivot when the world pivots, when the economy changes, the market changes, new technology arrives. I mean, who knows? The role of the investment banking analyst may get a lot smaller with AI. I mean, I don't think it's going to happen overnight, but I think some of the mundane tasks will be taken away and maybe fewer will be needed, but there's going to be more opportunities elsewhere. So develop as broad a skill set as you can. Don't look at college like trade school. Like, I'm going to be a refrigerator repair guy. I need to take these 4 courses. Oh, I want to be a Wall Street analyst. Therefore, I need these 4 courses. Try to take a broader perspective. Let serendipity be your guide as to where you go in life.
Oh, I love that. Well, thank you so much, Scott. For our listeners, again, Scott's book is Surviving Wall Street, A Tale of Triumph, Tragedy, and Timing. And this is available May 6th in stores and on Amazon everywhere. And if you're like Kristen, on Audible too, Scott, or no?
Some audio version very soon as well. And you can even pre-order already if you want to. So it's out there in all those different formats.
Awesome. Well, thank you so much for spending time with us, Scott. We so appreciate it. And congratulations on all your success.
Thank you very much. Great to talk to you both.